The Bank Secrecy Act, or BSA, was originally passed by the U.S. Congress in 1970 and signed by President Richard Nixon into law on October 26, 1970. It is also known as the Currency and Foreign Transactions Reporting Act and is a U.S. law requiring financial institutions in the United States to assist U.S. government agencies in detecting and preventing money laundering. Hey everyone, hope you all are well with specific trades and in good health. Welcome back to the channel. Today, we are diving deep into a topic that's crucial for the integrity of our financial system, as I mentioned in the beginning. But often misunderstood, the Bank Secrecy Act, or BSA. You might have heard the term thrown around, especially in news about finance or crime, but what does it actually do? Stick around, because by the end of this video, you'll understand exactly what the BSA is, why it matters, and how it impacts you and the financial world. So let's start with the basics. The Bank Secrecy Act is a U.S. law passed way back in 1970. Its official name is the Currency and Foreign Transactions Reporting Act, but everyone just calls it the BSA. The Bank Secrecy Act Advisory Group BSAAG is a U.S. government private sector firm established in 1992 by the U.S. Department of the Treasury. The BSAAG provides a forum for representatives from government agencies and financial institutions to share insights and challenges related to BSA compliance, recommend improvements to reporting requirements, advise on the detection and prevention of financial crimes within the scope of BSA enforcement. The main goal of the BSA is to prevent criminals from using financial institutions to hide or launder their ill-gotten gains. Think of it as the government's primary tool to fight money laundering, terrorist financing, and other financial crimes. It basically requires banks and other financial institutions to play a role in law enforcement by keeping records and reporting suspicious activities. Now you might be thinking, Secrecy Act? That sounds like it's about keeping my bank account secret. It's a bit of a misnomer, isn't it? The name is actually ironic because the law does the opposite of promoting secrecy. It forces transparency. It peels back the layers of secrecy that criminals try to wrap around their money. The law mandates that financial institutions report certain transactions to the government, specifically to a bureau within the Treasury Department, called FinCEN, which stands for the Financial Crimes Enforcement Network. So what kind of records are we talking about? The BSA has a few key requirements. First and foremost are currency transaction reports, or CTRs. If you go to your bank and deposit, withdraw, or exchange more than $10,000 in cash in a single day, the bank is legally required to file a CTR with FinCEN. This isn't because they think you're a criminal. It's an automatic, mandatory report. The $10,000 threshold was set because large cash transactions are a classic hallmark of money laundering. Criminals dealing in illegal activities often have tons of cash they need to get into the banking system. Let's look at an example. Imagine a drug dealer has $50,000 in cash from street sales. They can't just walk into a bank and deposit it without raising flags. So they might try to break it down into smaller amounts. This leads us to another key concept under the BSA, structuring, also known as smurfing. Structuring, as we have learned from our earlier presentation, is the illegal act of breaking up a large transaction into smaller ones specifically to avoid triggering that $10,000 reporting threshold. For instance, instead of depositing $50,000 at once, the criminal might make 6 separate deposits of $8,300 each at different branches or on different days. This is highly illegal. Banks are trained to spot this kind of behavior if a teller notices a customer consistently making cash deposits. Just under the $10,000 limit, they are required to file a Suspicious Activity Report, or SAR. And that brings us to the second major pillar of the BSA, suspicious activity reports. SARs are a huge deal. Unlike the automatic CTRs, SARs are filed when a bank employee suspects that a transaction might be related to illegal activity, regardless of the dollar amount. The threshold for filing a SAR is generally $5,000 if a suspect can be identified, but banks will file them for smaller amounts if the activity is suspicious enough. What counts as suspicious? Well, it could be anything from structuring, as we just discussed, to transactions that have no apparent lawful purpose or activity that is just plain weird for that particular customer. For example, let's say a small coffee shop owner who normally deposits about $2,000 in cash per week suddenly starts depositing $9,500 every other day. That's a red flag. Or what if a customer receives a series of wire transfers from countries known for high levels of corruption or terrorism, with no clear business reason? That's another red flag. Bank employees are trained to look for these anomalies. When they file a SAR, it goes to FinCEN, which then analyzes the data and can share it with law enforcement agencies like the FBI, IRS, or DEA to investigate potential crimes. These SARs are confidential. The customer is never told that a report has been filed on them. The BSA doesn't just apply to traditional banks. Its reach is incredibly broad. It covers credit unions, brokerage firms, money services businesses like Western Union or PayPal, casinos, precious metal dealers, and even insurance companies. Why casinos? Because they are classic venues for money laundering. A criminal could walk in with a suitcase of dirty cash, buy chips, play for a little while, and then cash out, receiving a check from the casino. To an outsider, it looks like legitimate gambling winnings. Because of the BSA, casinos also have to report large cash transactions and suspicious activities. Another important part of the BSA is the requirement for financial institutions to have a robust anti-money laundering or AML program. This is the internal framework a bank sets up to comply with the law. A typical AML program has several components. First, they need to have internal policies, procedures, and controls to detect and report suspicious activity. Second, they must appoint a designated BSA compliance officer who is responsible for overseeing the program. Third, they must provide ongoing training for their employees. Tellers, loan officers, and investment advisors all need to know what to look for. And finally, they have to undergo independent testing or auditing to make sure their program is actually working. If a bank fails to comply with the BSA regulations, the penalties can be severe. We're talking about massive fines, sometimes in the billions of dollars, and in some cases, criminal charges against bank executives. Regulators take this very, very seriously. One of the most significant updates to the BSA framework came with the USA Patriot Act, which was passed shortly after the September 11th attacks. The Patriot Act dramatically expanded the scope of the BSA with a much stronger focus on combating terrorist financing. A key part of this was Section 311, which allows the Treasury to designate foreign jurisdictions, financial institutions, or types of accounts as being of primary money laundering concern. This is like a financial death sentence. It can effectively cut off a foreign bank from the US financial system. Another huge part of the Patriot Act is Section 326, which implemented the Customer Identification Program, or CIP. This is something we have all experienced. When you open a new bank account, the bank is required to verify your identity. They'll ask for your name, address, date of birth, and a government-issued identification number, like your social security number or a passport number. They then have to check that information to make sure you are who you say you are. This Know Your Customer or KYC requirement is fundamental to preventing anonymous accounts that could be used for crime. So let's recap the journey of a piece of information under the BSA. You make a large cash deposit, the bank teller enters the transaction. Because it's over $10,000, the bank's system automatically generates a currency transaction report. That report is electronically filed with Financial Crime Enforcement Network or FinCEN. At FinCEN, powerful computer algorithms and human analysts sift through millions of these reports, looking for patterns and connections. Let's say your transaction, combined with other reports, links you to a network of individuals all making similar deposits across the country. FinCEN might then package this intelligence and send it to the Federal Bureau of Investigation or FBI. The FBI can then use that information to open an investigation, get subpoenas, and eventually build a case against a money laundering ring. All of this started with a simple report required by the Bank Secrecy Act. The BSA has evolved significantly over the years to keep up with new threats. With the rise of cryptocurrencies, for example, FinCEN has issued guidance clarifying that crypto exchanges and administrators are considered money services businesses and are therefore subject to BSA regulations. They have to register with FinCEN, implement AML programs, and report suspicious activities, just like a traditional bank. This is a constant cat and mouse game. As criminals find new ways to move and hide money, regulators have to adapt the rules to keep up. The BSA is a powerful tool, but it's not without its critics. Some argue that the sheer volume of reports, we are talking tens of millions of CTRs and SARs filed every year, can overwhelm law enforcement. It's like trying to find a needle in a haystack. Others raise privacy concerns, arguing that the government is collecting a massive amount of financial data on ordinary, law-abiding citizens. It's a delicate balance between security and privacy, and it's a debate that's ongoing. However, the successes of the BSA are undeniable. Information from BSA reports has been instrumental in thousands of criminal investigations, leading to the prosecution of drug traffickers, terrorists, corrupt officials, and tax evaders. It helps authorities trace the flow of money, identify criminal networks, and seize illegal assets. Without the BSA, our financial system would be far more vulnerable to abuse. So the next time you are at the bank and the teller asks for your ID or you see a notice about reporting large cash transactions, you'll know why. It's not about being nosy. It's part of a massive nationwide effort to protect the integrity of our financial system and keep us all safe from the criminals who seek to exploit it. The Bank Secrecy Act is one of the unsung heroes in the fight against financial crime. I hope this breakdown was helpful and gave you a clearer picture of what the Bank Secrecy Act is all about. It's a complex topic, but its core principles are pretty straightforward. If you found this video interesting, please hit that like button and consider subscribing for more deep dives into the world of finance and law. And as always, if you have any questions, drop them in the comments below. Thanks for watching, and I'll see you in the next one.